Now let's take a look at market activity today. We turn to one of the world's biggest bears, David Tice. David is the portfolio manager of the Prudent Bear Fund, the founder of theprudentbear.com, and fair and balanced as always, Chris Castaldo. He is our market bull. Chris is an equity analyst with Stock Traders Press. Welcome. Chris, I'm going to end with you, begin with you, because you cheer me up more and he bums me out. So you're upbeat.
Yes, I am. I like the market right now. I think if you look at market history over the last 20 years, even if you bought the S&P at the top, which some people certainly have over the last 3 years, if you've been patient and hold on to your securities, within the next 3 years, you're back to profits.
And you think we're going to keep doing this?
Oh, absolutely.
Okay, what looks best to you?
Well, I like right now the chip manufacturers. I think the increased usage of electronic handheld devices, cell phones, that's going to increase. So I think the chip manufacturers are going to do very well. I also like the energy stocks, particularly Plug Power. They're an alternative energy with all the energy crisis we have going on throughout the United States and California. I think fuel cell companies such as Plug, I think they're going to do very well over the next 6 to 12 months.
So that's what they are? They're a fuel cell company?
Yes, they make alternative energy. They do provide fuel cells.
All right. And meanwhile, David, you're still leery of this whole turnaround, aren't you?
Yes, we are. We think this is an economic bubble and a stock market bubble, Neil. And Chris made the point about how the last 20 years it made sense to be in the market. We think that that's a problem for most individuals. They've only looked at 20 years. You look back at stock market history going back 100 years, you'll find that that's last 20 has been the best in this century. That's not the time to be invested in stocks.
Yeah, but you're also a great student of market history. I mean, from the 1929 experience thereafter, all these market corrections, crashes, whatever you want to call them, they almost look like little asterisks along the ride.
Well, what's happened, though, Neil, at the end of the two biggest secular bull markets in history, in 1929 and in 1966, had you been invested at the top, it would have required you 24 and 27 years to recoup your initial investment.
Wait. Are you saying now for people who invested at the top of this most recent bull market, it's going to take them that long to recoup their money?
I think it is possible. Some of these people that are in at Cisco at 80, they might have to wait one heck of a long time.
Let me explore that with you, Chris, because I've heard the Cisco analogy and other analogy, the real high flyers, that if you had bought at the top, it would take you a long time, just in average growth, to make up that. So what if you were the unlucky guy who had those issues at those highs? You're screwed, right?
Well, no, I disagree, because if you're talking a longer term and not just 20 years, if you look back to 1920, any time that the Fed had 3 consecutive rate cuts, let's just look 6 months past those rate cuts. We've seen the average maximum gainer at 16.8%. That's just 6 short months after the, 3 consecutive cuts.
What does it mean when you have 4 or 5 rate cuts? It just adds gravy to that?
I think it does. It's going to add a little bit more momentum, and it's showing that the Fed is committed to bringing this economy.
But there are periods, I think in the 30s where we had that experience where we didn't see any appropriate.
We have had a prolonged slowdown, but I don't think you can compare the market today.
Bottom line, you're confident.
Absolutely.
Bottom line, you're still suicidal.
And really, on the rate cut side, if you look back in 1973 or 1981, Fed was cutting rates back then. The market went up. But you know what? The market was selling at 6 times earnings. It had a 6% dividend yield. It was selling. The Dow was selling under book value. These are different.
So what do we go to, Dave?
Unfortunately, we've got to go to 3,000 probably on the Dow. It's going to be very uncomfortable.
So almost a quarter what we are now.
Unfortunately, we have to work out these excesses.
How soon?
Probably sometime in the next 9 to 18 months.
Now, to be fair, love you dearly. You've been saying this for a long, long time. You've been wrong for a long, long time.
Yeah.
So eventually you feel you'll be right. What will be the catalyst?
Well, the catalyst is going to be we're borrowing too much money from foreigners. We cannot continue to cut rates.
We've been borrowing money from foreigners for as long as I've been alive.
But we're getting to an extreme. Listen to what Larry Lindsay said last week. He said something has got to give. We're borrowing $520 billion this year. He said by 2003 it might be $800 billion.
Is that a worry for you, that we're borrowing like crazy?
No, I don't think so. Not at all.
All right. Chris, final word on the subject. Dave, we'll see what happens. You didn't hit each other. It was a good sign.
Yeah,
all right. Coming up next, the Fox Financial All-Stars put it all together. Then why cutting interest rates over there is good news for us over here. Maybe. David notwithstanding. After this.